Nio reached its all-time high of roughly $67 per share in January 2021. What does it mean? We're here to analyze Nio and take a closer look because the stock has dropped nearly 90%. We don't want to dismiss it as a garbage investment just because it was $67 before. Does it mean that it's a bad investment at $10? Stay tuned as we discuss the bull and bear cases, their stock history, analyst estimates, and our predictions for the coming years. As of July 10th, Nio is priced at $10.57, a significant drop from its peak of $67 around 2.5 years ago. Back then, the market sentiment towards Nio was incredibly bullish, with many believing it was destined for success. However, things have taken a turn, and the stock has experienced a significant decline. In fact, it hit a low of $7 on June 1st, just a few weeks ago. Over the past week, it has seen both ups and downs, with a 10% increase followed by a 10% decrease. Looking back at the detailed Nio stock price history for June and July 2023, it was quite a ride. In early June, the stock opened at 7.66 and went up to 10.21 by June 12th. But then, it dropped to 8.28 on June 19th before closing at 9.69 on June 26th. In July, it opened at 10.15 on July 3rd and reached a high of 10.49 before closing at 9.99. There were some ups and downs, but the stock showed an upward trend from the beginning of June to the beginning of July. Now, let's delve into some basic details about Nio. First, it has a market capitalization of $14 billion. This means that if you were to purchase every outstanding share, you would need to invest $14 billion to own the entire company. However, if we consider the enterprise value, which includes buying all the shares plus accounting for debt and subtracting cash, the figure stands at $18.5 billion. The difference here represents the debt, but it doesn't strike me as alarming. However, when we examine the free cash flow over the past year, my friends, things start to look concerning. It hasn't been great. On the other hand, the revenue has been quite impressive, reaching $6.8 billion. Since Nio is a Chinese company, let's focus on its annual data. Upon examining the annual figures, it becomes apparent that Nio has experienced losses almost every year except for one, which happens to be the same year it generated positive free cash flow, 2020. It's quite remarkable that it took a global pandemic for them to achieve profitability, and even then, it was only marginal. Frankly, that's not an encouraging sign. However, it's important to note that Nio is a rapidly growing company, and investors are often willing to pay a premium for such companies. They could potentially become China's leading electric vehicle manufacturer, and I commend them for that ambition. Nevertheless, there comes a point where the price becomes too high, even for a fast-growing company. Nio has forged several partnerships, and one notable collaboration is with an investment group based in Abu Dhabi, which is a part of the Abu Dhabi government. It seems to be a common strategy among companies in this industry to secure funding from the Middle East. Rivian, for instance, is also pursuing similar avenues, and Lucid, which is currently heavily involved with Saudi Arabia. In Nio's case, they have established a 5-year agreement with an auto parts giant to handle their die-casting operations. These partnerships provide Nio with various advantages. They currently hold 23% of the market share in China, and their delivery numbers have increased by 16% year over year. But before we continue, we want to thank you for watching this far. Now, let's take a look at what analysts are saying about the company. It's important to note that despite the significant drop in price from $67 to $10, we remain cautious. Simply because something is cheaper doesn't necessarily mean it's a better value. Keep in mind that price is what you pay, but value is what you receive. It's crucial to remember this distinction. The sentiment surrounding Nio has indeed been understandably cautious lately, which is reflected in the significant decline of its stock. This sentiment is not unique to Nio alone, but can be observed across other car companies like Workhorse, Nikola, Lordstown, and Foxconn. It's undoubtedly a challenging environment for these companies. Nio stock started June with a low of $7.24, but surged to a high of $10.15 by mid-month, thanks to strong delivery numbers and positive analyst ratings. However, the stock faced a sharp sell-off in the second half of the month as investors worried about the impact of the global chip shortage and the competition from Tesla and other rivals. The stock hit a low of $8.40 on June 26th, but rebounded to $10.78 on July 10th as the company announced a new battery swap station partnership and a record delivery target for July. Overall, the stock gained 45% in the past month, outperforming the broader market and the electric vehicle sector. On the revenue side, things seem more predictable. As expected, Nio is experiencing significant revenue growth. The numbers are impressive, with revenue projected to reach $11.5 billion this year and grow to $34 billion by 2027. But we also need to consider the bear cases, which suggest that Nio is losing domestic market share in China and is aggressively cutting prices. It's unclear how these factors align with the substantial revenue growth projections. Despite the market share loss, Nio still has the potential to grow and succeed as a company. Now, let's proceed with a 10-year analysis of Nio. Looking at the return on invested capital, ROIC, it's understandable that it's negative, considering Nio's lack of operating income. ROIC is calculated by dividing the net operating profit after tax by the amount of money invested in the business. When a company has no profit, it naturally leads to a negative ROIC. However, it's important to note that negative ROIC is often expected for growing companies and startups. Let's focus on the critical margins and revenue growth aspects for the next 10 years. These numbers are intended to showcase the potential for significant growth, especially with the higher estimate. For revenue growth, let's consider a low estimate of 18%, a middle estimate of 24%, and a high estimate of 30%, assuming profit margins of 3%, 6%, and 9%, considering starting PE ratios of 16, 20, and 24 as potential options. Since Nio is not currently profitable, we need to account for a higher margin of safety in our desired return. Let's consider margins of safety at 15%, 20%, and 25%. We'll then have 6 results: a low price estimate of $385, a high price estimate of $17, and if one were to pay the current price of $10.78, the returns would be approximately 5% for the low assumptions, 21% for the middle assumptions, and 35% for the high assumptions. While the numbers may seem appealing, it's essential to question whether such scenarios are realistic and whether the investment is appropriate. It's worth considering a cautious approach, such as allocating a small portion of your funds for a long-term investment in Nio. This approach allows you to observe the developments over the next 10 years while managing risk. In conclusion, while Nio may face challenges and uncertainties, it's essential to acknowledge that growth and success potential exist amidst market share losses and aggressive price cuts. So, what's your verdict on Nio? Is it a leap of faith or a calculated investment? Let us know your thoughts in the comment section. And don't forget to hit that like and share button for more content like this. Thanks for watching. This is Nate, and I'll see you in the next one. Did you know that Nio also invested in nuclear energy? Check it out in this next video.